Most people will use it as a measure of whether or not the stock is cheap or expensive. And as I said earlier on, this is partially true, but not always. Earnings per share divided by price per share, and then I'll multiply it by 100% to get what we call an earnings yield. Then you're going to behave very differently from the stock market. And guess what, guys? 90% of people lose 90% of their money in 90 days when it comes to the stock market. Hello guys, welcome back to the channel, best place for long-term stock investors. My name is MJ, and today we're going to talk about the P/E ratio. What is the P/E ratio? How do you actually use it in practice? And if you stay until the end, you'll know what is useful about it and when is it not useful. Now, before we begin, have you gotten your free guidebook where we talk about a lot of other ratios, not just the P/E ratio? So you might want to check it out. Link is in the comments. All right, let's start with what is the P/E ratio and how do you actually calculate it? So the example I would give is, let's say you can imagine company A and company B, right? Both of them, if you were to buy the whole business, will cost you 10 million ringgit. Now, you also assume that both companies are in the same industry and they are competitors, right? And both of them are profitable. Now, what is profit, right? Profit is just revenue minus cost. So for example, if let's say you are selling a hot dog, revenue would be how many hot dogs you sell multiplied by the price of the hot dog. You get the sales. But the cost will be like actually getting the raw materials like hot dog, the bread, and then maybe paying for rent if you rent a place, buying utensils, things like that. So after you take the revenue minus the cost, you get the profit. Now let's say company A has a profit of 1 million ringgit and company B has a profit of 5 million ringgit. Which one would you buy? Okay, so if you buy company A, it will take you 10 years to recoup back your money. How? Well, you paid 10 million ringgit for the business, right? So if every year it generates you 1 million ringgit, it means it will take you 10 years to get back all your money. Now, in contrast, if you bought company B, which made 5 million a year, it will only take you 2 years to get back that 10 million. So unless you like to make money in the slowest way possible, it's quite obvious that company B is the right choice, right? As it takes a lot shorter time to receive back the money. And so that's the basic idea of how PE works, right? It's taking the price of the business, the entire business, and then comparing it with the earnings or the net profit. When it comes to the calculation of the PE ratio, it's relatively simple. All you need to do is to take the price per share and divide it by the earnings per share. So for example, if you have a stock that is 1 ringgit and you want to know the PE ratio, you just have to find out the earnings per share. So if the earnings per share, let's say it's 10 cents, that means you have a PE of 10. And if the earnings per share is 1 cent, that means you have a PE of 100. So based on what I've just explained to you, you might think, well, okay, does that mean that the lower the PE, the better the stock? Sometimes it's true, sometimes it's not. And I know it's a little bit confusing, but stay until the end of the video. That's where I explain to you when it works and when it doesn't. Now, before we move on, if you're enjoying the video so far, remember to give it a like and of course subscribe if you haven't. And if you already subscribed but you haven't clicked on the notification bell, please click on it so that you know when new videos are out fresh for you. So as I explained earlier, basically as a principle, you want the P to be low, right? Now, how low is low and how high is high? And sometimes it gets a little bit confusing. So one thing that I like to do is to actually invert it. So what I'll do is, instead of taking price per share divided by earnings per share, I'll flip it around and I'll calculate the ratio of earnings per share divided by price per share, and then I'll multiply it by 100% to get what we call an earnings yield. Now, why is an earnings yield important? Because you get the percentage term, which you can then compare it with other investments, right? So for example, if there's a stock with a P of 10 and I invert it and multiply by 100%, I'm basically getting a 10% earnings yield stock. So with that number, what I'm now able to do is to compare it with other investments that are maybe yielding 7% or 17% and get a gauge whether or not it is cheap or expensive. And another thing I like to do is to also compare it to the risk-free rate. What is the risk-free rate? Basically, it's any investment that you can make that you will get guaranteed return or risk-free. So in Malaysia's case, that will be the fixed deposit rate. As of this recording, is something like 1.75%, 2%. And if you're in the US, you'll be using the 10-year US Treasury rate, which as of this recording, about anywhere between 1 to 2%. So another thing about the risk-free rate or comparing it with the risk-free rate is that because the investment is risk-free and guaranteed, and when you invest in the stock market, you're actually investing in more risk, correct? So what you have to do is to make sure that the yields are higher than the risk-free rate 2-3 times, hopefully, because you're taking more risk. And so you need more returns to justify you putting money into the stock. Now, another way to use it that is not really taught in the in mainstream investing education, or even if you Google it, you don't really find things like that, is actually instead of saying the PE ratio tells you how long it takes to recoup your money back, another way is to say how much are people willing to pay for that stock, right? And so it is somewhat of a measure of the quality of a stock. Now, what this means is that even if a stock is, let's say, at 30 or 40 PE, which is generally considered high, that doesn't mean that it is a bad company or it's a bad investment, right? What's that tell? Oh, they need to do fun. What's that? Usually, what that mean? What's that mean? What that means? Okay. I'm gonna do it again. Usually, what that means, got it right this time, is that it's a high quality asset, right? Think of it as a car, right? Is a car bad because it is expensive? No. And stocks are, very often the same. So that's something you need to keep in mind whenever you're thinking about PE ratios, because sometimes even the PE is high, it can go higher. And when the PE is low, it means that it is a bad quality asset and it can actually go down even further. And there are many cases where very smart investors lose a lot of money simply because they bought a low PE stock. And I'm one of them. Now, so when is the PE ratio useful? Most people will use it as a measure of whether or not the stock is cheap or expensive. And as I said earlier on, this is partially true, but not always. At FIRL, we see it as a timing tool, right? An indicator as to whether we should enter the stock or exit the stock. So let me explain a little bit further, right? So when it comes to the net income or earnings of a stock, it is actually reported every 3 months, or what we call a quarterly basis. However, the stock prices, which is the other component of the PE ratio, changes every day, right? It fluctuates a lot regardless of the earnings. So when the price per share of a stock drops from, let's say, 10 to 1, but the earnings never change, well, now the PE ratio went from 10 to 1. So why is this useful? Is because for most stock market investors, they care about the price only. So if a stock goes from 10 to 1, right, it might look like it's definitely on a downtrend, and that will scare a lot of investors away. But if you are an investor and if you treat a stock not just as a piece of paper or a number on a screen, but actually a business, then it might seem like a good opportunity to buy actually, right? Especially if you know that the earnings, again, which is the other component of the PE ratio, is good. So when it drops from 10 to 1, a lot of, let's say, traders or speculators or people who just entered the market might think, well, it's bad to go in because it's on a downtrend. But to an investor, he might have a different opinion. So, the beauty of the PE ratio is that it takes into account two very important components. Number one is the expectation of the shares, right? And number two, it takes into account also the fundamentals of the shares. And usually the expectations and the fundamentals match, but where you as an investor, as an educated investor, can actually make money is when the expectations and the fundamentals detach. So for example, if it drops from 10 to 1, the price has gone down a lot. But if the business is doing well, it's great, it's receiving new orders, it's stocking up inventory because it anticipates future growth and things like that, then you're going to behave very differently from the stock market. And guess what, guys? 90% of people lose 90% of their money in 90 days when it comes to the stock market. So usually the guy who does make money in the stock market is the one with a slightly different opinion. Okay, now let's look at when the PE ratio is actually not useful, or when is it actually a weakness to use the PE ratio. The first is when the earnings, right, it's not consistent. If it goes up and down all the time, then the PE ratio is basically fluctuating, up and down all the time, and it's not very useful in that case. So cyclical companies, for example, not too useful. Number two is when the company is new, right? Because usually new companies, they're not actually profitable, right? This was true for companies like Amazon, Facebook, a lot of these more startup type companies where they're great businesses and they're great investments, obviously, but they didn't have any earnings. So if you use the PE ratio, you have totally missed out Amazon, which has gone up many, many, many times, right? So that is one thing you need to take note of as well when it comes to the PE ratio and when not to use it. So the next weakness or bad thing about using the PE ratio is that sometimes it does not take into account one-off items. So one-off items are usually purchases or sales that affect the net income or the earnings that are not related to the operation. So what do I mean, right? So take for example, let's say every year a company makes 10 million, right? And then so happen it decides to sell one of its factories for 50 million. So the 50 million that they get, that gets registered as profit or other income. So what happens? If it makes 10 million every year and then suddenly the year they sold the factory, they're making 60 million. So initially, maybe it was only 20 times earnings, but because the earnings, the PE ratio is 20 times, but because the earnings went from 10 million to 60 million, now the PE ratio drops down to less than 5. So then it might look cheap to you when in fact, nothing has changed. And so then maybe you start buying just because of the PE ratio looks low. But that's only a once-off, right? Because the next year, when things go back to normal, when they don't have another factory to sell, then the earnings will go back to 10 million. Now, the other side is true as well, right? Let's say they have one big expense, right, that shrinks the PE ratio. So maybe it was at 10 times PE, but you have a cost that is a once-off. Maybe they were going through a legal battle, let's say, and instead of making 10 million, it dropped to 2 million. Right, so then the PE will have gone up many, many times, right? Instead of 10, maybe it's now 50 times. And you might think, well, that means it's expensive, and so you don't buy it. When in fact, it is a pretty good price to buy at. So that's the third reason you should actually take note of, or I wouldn't say reason, but the third scenario where the PE ratio is not very useful. Now, the next one is a really big situation or scenario where the PE ratio is not very useful, and that is when the business is going through change, or that the ratio does not take into account these changes. So take for example newspapers, right? Today in Malaysia, one of the most famous stock that we have is Star Media, right? It is a company that used to be very dominant in the media industry. And the PE ratio was very low for a long time. And so you might think, well, the PE ratio is so low, therefore it is cheap, therefore I should buy it. The problem with that is that the newspaper industry is not doing very well. It is dropping by double digits every year. In this kind of scenario, it's actually a very bad idea to use the PE ratio. Now, the reverse is true as well, right? A company might be trading at 50 times PE, but it's in an industry that's growing really fast, right? The earnings are doubling every 2 years, every 3 years, every 5 years. And so in those scenarios, buying a stock at 40 or 50 times earnings might not be a bad idea because the industry that you are in is growing at a fast and rapid pace. And of course, if the industry is growing, that means more people will be interested in that kind of stock and more people will be interested in putting money into that stock. And all of this will drive the share price up versus a newspaper company, right? It's just not going to happen. So that's it for the PE ratio. Hope you understand it a lot better now. Hope you've been equipped with the knowledge to actually use it practically when it comes to actually putting money in the stock market. And if you enjoy these sort of videos, remember to watch some of our other videos. Remember to give us a like on Facebook, follow us on Instagram, hop on our Telegram channel, and see you in the next video.